Okay, good evening. This evening, I will be discussing the remaining problems in chapter 19 and hopefully take up problems in chapter 20 and chapter 21. Now, in 19-5, we are asked to compute the average ordinary shares outstanding and compute the basic earnings per share. The company had net income of 15 million for the current year. The following appropriations have not been considered in this amount: arrears of cumulative preference dividend for 2 years, 4 million; ordinary dividends, 5 million; preference share premium payable on redemption; and exceptional profit net of tax. The entity had 3 million ordinary shares of 1 peso par outstanding at the beginning of the year. The following transactions occurred during the year: January 1, issued at 5 per share, 1 peso, paid to date and entitled to participate in dividends to the extent paid up. April 1, full market price, 3 pesos per share issue. And July 1, purchase of own shares at 3.50 per share. Now, let's begin with the computation of the average ordinary shares outstanding. So, for ordinary shares, in January 1, we have 3,000 ordinary shares. So, we multiply it by 12 over 12, January 1 to December 31. So, we have 3,000. Then, still in January 1, 250,000 shares, 1 peso paid to date. So we have now to multiply 250,000 by 1/5 times 12 over 12. So it's still January 1 to December 31. Issued at 5 per share, 1 peso paid to date and entitled to participate in dividends to the extent paid up. So that's 1 over 5. Then we have 50,000. On April 1, full market price, 3 per share issue, 600,000 times 9 over 12, beginning April 1 up to December 31 for 450,000. In July 1, purchase its own shares at 3.50 per share. So we have 400,000 shares. Then July 1 up to December 31, it's 6 over 12 or 200,000. So we deduct being shares in treasury. Total now of 3,300 shares, the average number of shares. Second, compute the basic earnings per share. For number 2, net income per book is 15 million. Then we have the exceptional profit of 4 million. And we have the adjusted net income of 19 million. Then the preferred dividend for the current year, 4,000 divided by 2. So arrears of cumulative preference dividend for 2 years, total of 4 million divided by 2 because that's good for 2 years. So we have now the preferred here is cumulative preference dividend. So we have the preferred dividend for current year only, 2 million, and the preference share premium payable upon redemption equal to 1 million. So we now get the amount of net income to ordinary shares of 16 million. The preference share premium is actually a preference dividend for a participating preference share. So the basic earnings per share, as we have to remind ourselves that basic earnings per share applies only to ordinary shares and not to preferred shares. So basic earnings per share, 16 million. We divide it by 3,300 average ordinary shares. So we have now 1.4.85. Next, we go to problem 19-6. Compute the basic earnings per ordinary share and per preference share. We have now London Company with the following share capital at the end of the current year. Preference share capital, 30,000 shares. Ordinary share capital, 100,000 shares. And net income for the year. The preference dividend rate is 8%, and the preference share is non-convertible but cumulative and fully participating. After the ordinary share has been paid a dividend of 10 pesos per share, the preference share shall participate in any additional dividend on a pro rata basis with the ordinary share. So in problem 19-6, we now begin with the basic dividend. So we have the basic dividend as to be computed. The basic dividend of preference share at the rate of 8%. So we have 8% multiplied by a preference share capital of 3 million, so 240,000. Then to ordinary, as stated, we have a 10 peso. After the ordinary share has been paid a dividend of 10 per share. So we have 10 times 100,000 ordinary shares or 1 million. So the balance for participation is now for preference, we have 510,000 and for ordinary, 850,000. Now take note the computations at the bottom for the distribution of the balance. The preference shares with par value of 3 million, the ordinary of 5 million. So the fraction is 3 over 8 and 5 over 8. And now we are going to allocate the amount of 1,360,000. We have to give 510,000 to preference and 850,000 to ordinary. So that gives us the total of 750,000 to preference and 1,850,000. We are distributing the net income for the year equal to 2,600,000. That's 2,600,000, and initially we have given to preference 240,000 and to ordinary 1 million. So the total of 1,240,000. We have a difference of 1,360,000. That was the balance for participation. So the basic earnings per share for preference, it's 750,000 divided by 30,000 shares. And for ordinary, we have 1,850,000 divided by 100,000 shares. So we have 25, and the ordinary is 18.50. Now we understand that we mentioned about the earnings per share, that the earnings per share is the amount attributable to every ordinary share outstanding during the period. So earnings per share information pertains only to ordinary share. However, for the preference share, we can also compute the basic earnings per share considering the earnings rate of the preference share, that is the rate attached to preference share. So in this problem, we have the rate attached to the preference share, which is 8%. And the preference share is cumulative and fully participating. Now, in 19-7, we have for that's years 2020 and 2021. So, for 19-7, question number 1, compute the theoretical value of share X right. Now, we have the theoretical value of share X right. We have now 11. 11 minus 5, and we divide it by 5 plus 1. So that gives us 6 over 6. We have 1 peso per right. So that's now your theoretical value of the share X right. Now take note of the formula. You have now your market value of share rights on, that's 11, and the theoretical value of right is 1. So we have now the market value of share X right is 10. So we now have 11 minus 5 and divide it by 5 plus 1. So on January 1, 2021, the entity granted rights issue in the ratio of 1 new share for every 5 outstanding shares, so a total of 120,000 shares. The rights are exercisable on March 1, 2021, and the exercise price is 5. The market price of one ordinary share immediately before exercise of rights on March 1 is 11. So we have now the amount stated and the market value of one right. We have here 1 peso per right. So the market value of the share rights on is 11. The theoretical value of right is 1. And we have the market value of share X right equal to 10. So the adjustment factor now is 11 divided by 10. That's in question number 2. Meaning we are dividing the market value of share rights on by the market value of share X right. So we have the adjustment factor. Compute the basic earnings per share for 2020, 21, and 22. So for shares outstanding of 600,000, that's the number of shares outstanding during 2020, and the adjustment factor is 1.10. We now get the adjusted shares of 660,000. So the basic earnings per share is 11 million. Net income for 2020 divided by 660,000 adjusted shares. So we have 16.67. In 2021, January 1, we have 600,000 shares. We multiply it by 1.10, and we have 2 over 12. So 2 over 12, as we have to use now 1/6, giving on January 1, 600,000 times 1.10 times 2 over 12 is only 110,000 from January 1 to March 1. Then March 1, 720,000. That's the adjusted amount of 720,000, and then we multiply it by 10 over 12. That's from March 1 to December 31. So on January 1, we have 110,000. On March 1, multiplying 720,000 by 10 over 12, 600,000. By the way, in January 1, we have 2 over 12. That's counting from January 1 to March 1. And then on March 1, we have 10 over 12, counting from March 1 up to December 31. So the basic EPS now in 2021, considering the net income of 15 million, and then we divide it by 710,000. That's your adjusted number of shares. So the basic EPS is 15 million divided by 710,000 as the adjusted number of shares. So we get 21.13. Then in 2022, we have the basic EPS equal to the net income of 18 million, and we divide it by 720,000 shares. That's at the end of 2022. So we now get the rate of 25 per share. Next, we go to 19-8, compute for the theoretical value of share X right. Then compute the adjustment factor and the basic earnings per share for 2020 and 2021. Now, the company offered existing shareholders a rights issue of 145 shares at the price of 6 per share to be exercised on April 1, 2021. The market value of share was 12 pesos on that date. On January 1, 2020, there are 810,000 ordinary shares outstanding. The entity reported net income of 2,250,000 for 2020 and 3,500,000 for 2021. So first, we have to determine the market value or the value of right. That's theoretical value of right. Value of right, we have now 12 minus 6, and we divide it by 5 plus 1. So 12, the market value of share on that date, and 6, price per share to be exercised on April 1. So we have now 12 minus 6, and we have 5 shares plus 1. So we have 6 over 6 or 1. Now the market value of rights on is given at 10, and the value of right is 1. So the market value of share X right is 9, as we are now given the amount of 9 as the market value of share X right as required in number 1. So the adjustment factor is 10 divided by 9. We have the adjusted or the adjustment factor. So in number 3, compute the basic earnings per share for 2020 and 2021, for 2020 and 2021. In January 1, 2020, we have 810,000. We multiply by 10 over 9. That's the adjustment factor. So we get 900,000. So the basic earnings per share is 2,250,000. The amount of net income divide by 900,000 shares, it's 250. And for January 1, 2021, we still have 810,000 times 10 over 9 times 3 over 12 from January 1 to April 1. So 225,000. April 1 up to December 31, That's for a period of 9 over 12. So we have now 810,000 for the amount of, or for the number of shares in the adjustment factor. So 810,000 plus 162,000 times 9 over 12, as we have the date here as April 1, 2021. So we now get the earnings, or the average shares, equal to 954,000. And now we divide the basic earnings per share for 2020 is, for 2021 is 3,500,000 divided by 954,000. That's your average number of shares. So, up to the year 2021. Okay, so we have now problem na 19-8. Then we go to 19-9. We have net income given of 750,000. And then we have the preferred dividend equal to 120,000 on the ordinary, 120,000 on the preference share. The net income to ordinary share is 630,000. So the basic EPS is taken by dividing 630,000 by 60,000 shares. So that's now your adjusted number of shares given in the first part of the problem. Then we have 10. 19-10. Royal Company reported the following capital structure on January 1, 2020. Shares issued and outstanding: ordinary share capital 200,000, preference share capital for 50,000. We have the ordinary share capital of 200,000, preference share capital of 50,000. On October 1, 2020, the entity issued a 10% share dividend, a 10% share dividend on ordinary shares, and paid the annual cash dividend of 200,000 on preference shares. The preference share is non-cumulative, non-participating, and non-convertible. Net income for the current year is 1,920,000. What amount should be reported as basic earnings per share? So in number 10, first we have the ordinary shares. On January 1, 2020, that's 200,000. Then the stock dividend on October 1, 2020, 10% share dividend or stock dividend. So 10% multiplied by 200,000 as the original number of shares. So we have 20,000 shares. So the total ordinary shares outstanding is 220,000. Our net income is 1,920,000 less the preference dividend, equal to 200,000 as given in the problem, that the company paid the annual cash dividend of 200,000 on preference shares. So the net income to ordinary shares is 1,720,000 divided by the ordinary shares outstanding. We get 7.82. That's the basic earnings per share. Next, we go to 19-11. What amount should be reported as basic earnings per share? The ordinary shares outstanding, we have 1 million divided by 5. So we have 1 million and the par per share is 5. So meaning we have 200,000 shares. The basic earnings per share with net income of 4,300,000 divided by the number of ordinary shares outstanding of 200,000, we have 21.50. The preference dividends ignored because the preference share are redeemable and therefore the preference dividend of 500,000 is already deducted from the net income as a finance cost. We are given the preference dividend of 500,000 on redeemable preference shares. So in other words, this amount was already deducted from the net income before the amount of net income was given. Next, we have 19-12. What amount should be reported as basic earnings per share? So we have now the amount of net income for the current year of 5 million. Then we have the preference dividend for 1 year, 2.5 million multiplied by 4%. So it's 100,000. So net income to ordinary share is 4,900,000. So the basic EPS is 4.9 million divided by 200,000 shares. So we have the 200,000 ordinary shares. So we now get the basic earnings per share to the extent that we have 200,000 ordinary shares and net income is 4.9 million. So we divide and get 24.50. In the case of number 12, it's letter B as in boy. Next, number 13, question in the computation of basic earnings per share. What is the amount to be used as earnings? Since we are given the net income of 1.8 million and the income tax rate for the year was 30%. In the absence of any contrary statement, the preference share is non-cumulative. Here it's non-cumulative. It's really given. Accordingly, the annual preference dividend is not deducted from net income because there is no declaration. There's no declaration and the preference share is non-cumulative. But if it's cumulative, then it has to be deducted. The basic earnings per share should be 1.8 million divided by 20,000 ordinary shares or 9 pesos. So net income for the year was 1.8 million. That's the final amount of net income. Next, in number 14, what amount should be reported as basic earnings per share? So in number 14, the ordinary shares issued is 30 million. That's given divided by 100 pars, so it's 300,000 shares. Then the treasury shares given at 50,000. So we have now the ordinary shares outstanding of 250,000. Now, if the net income is 15 million as given, we have the net income of 15 million for the current year. Then we deduct the preference dividend at the rate of 10% of 5 million. So the preference dividend is 10% cumulative. So we multiply 10% by par of 5 million, we get 500,000. Net income to ordinary shares is 14,500,000 divided by 250,000 shares computed above. We have the basic earnings per share equal to 58. Then in number 15, what amount should be reported as basic earnings per share? Basic earnings per share is 7,100,000, and we have to divide it by 400,000. On January 1, 2020, King Company had 200,000 ordinary shares. So, 200,000 ordinary shares and 100,000 of 4% par value cumulative preference shares. No dividends were declared on either the preference or ordinary shares in 2019 or 2020. On February 10, 2021, prior to the issuance of the financial statements for the year ended December 31, 2020, the entity declared a 100% share dividend on the ordinary shares. So the net income for 2020 was 7.5 million. So what amount should be reported as basic earnings per share? Now, if we have to determine the number of shares in number 15, how many shares now are considered to be outstanding? So, initially, it was 200,000 shares, and we have 100% share dividend declared on the ordinary shares. So, meaning the number of shares increased by 200,000, making the outstanding shares equal to 400,000. So, in other words, the initial was 200,000, and lately we have the issuance of share dividends that made it a total of 400,000 shares. So from the net income of 7.5 million, we have to deduct the share of the preferred equity or the preference equity, even though there is no declaration, but the preference or the ordinary shares in 2019 or 2020, there was no declaration. However, the preference shares outstanding are considered to be cumulative. So, with 100,000 shares of the preference shares outstanding, and then we multiply it by 4%. 100,000 multiplied by 100, or you have 4%, multiply mo. So we now get total of 100 per share par value, and then we multiply by uh, a total of 100,000 shares. So we get 10 million for the total number of shares. So 100,000, 100,000, 4%, 100 par value, cumulative preference share. But we have now the dividends on the preferred. That's only good for 400,000, so that the balance applicable to the common is, or to the ordinary shares, is 7,100,000. 7,100,000 divided by 400,000 shares, that gives 17.75 for the basic earnings per share. in number 15. Then we go to number 16 with two requirements. What amount should be reported as basic EPS for 2021 in the 2021 comparative income statement? The company had one class of share capital outstanding and no other securities that are potentially convertible into ordinary shares. During 2020, 120,000 shares were outstanding. On April 1, 2021, 40,000 shares of treasury were sold, and on July 1, 2021, a 2-for-1 share split was issued. So net income in 2021 was 6 million, and in 2020 it was 3.6 million. What will be the basic EPS for 2021 in the comparative income statement? So in number 16, question number 1, January 1, 2021, we have an initial number of 240,000 shares. So 40,000 to 120,000 shares, and then we multiply by 2 because of 2-for-1 split. So we now get the 120,000 shares, and we multiply by 2, that makes it 240,000 by January 1, 2021, and we multiply it by 12 over 12. So meaning January 1 to December 31. On April 1, 2021, 40,000 shares of treasury were sold. So we now get 40,000 again times 2 because of the split, and we multiply by 9 over 12. So from April 1 to December 31. So meaning it's 80,000 multiplied by 9 over 12. So 60,000. The average number of shares is 300,000. Now, so for the EPS in 2021, we have the net income of 6 million divided by 300,000 shares. So it's 20. Question number 2, what should be the amount to be reported as basic EPS for 2020 in the 2021 comparative income statement? So for question number 2, December 31, 2020, the balance is 120,000 shares. Then July 1, there was a 2-for-1 share split to 120,000. So we have now the total of ordinary shares on December 31, 2020 of 240,000. So in the 2020 year, the EPS is net income of 3,600,000 divided by 240,000 shares. So we have now your earnings per share equal to 15. Next, we have 19-17. 19-17, we have the weighted average number of shares outstanding for the year. At the beginning of current year, Nissan Company had 100,000 ordinary shares outstanding. During the current year, the following events occurred. So we have now on March 1, 2-for-1 split. So we now compute for the average number of shares outstanding in 19-17. So January 1, 100,000 shares. We multiply by 2 because of the split. And we multiply by 1.20. because again on September 1, we have 20% share dividend. So 240,000 shares. Then on June 1, we have issued 30,000 additional shares. So 30,000 we multiply by 1.2 because of the share dividend on September 1. So we get times 7 over 12 from June 1 up to December 31. Now, actually, the June 1 issuance of additional shares was no longer affected by the split up because this split up occurred on March 1. So it was only the beginning ordinary shares. So the average number of shares is 261,000. Now, in problem 18, what is the weighted average number of shares outstanding for the year? Okay, so number 18. Again, we are going to determine in the case of number 18, the January 1, we have 100,000. That's the beginning shares, 100,000, but we multiply it by 2 because of the split on May 1. And we multiply it also by 1.2 because of the bonus issue. And we multiply by 3 counting from January 1 to April 1. So that's for 3 years. I mean 3 months. So 720,000. Then on April 1, we have the additional issuance of 30,000 previously unissued shares. So 30,000 we multiply by 2 because the split occurred after. And the bonus 1.20, and we have 3. So we have now the period from April 1 to December 31. Now April 1 up to June 30 is again a period of 3 months times 9 over 12 from April 1 to December 31. Okay, so we have now the split the share 3 for 1 on December 31. So the split now occurred on December 31. It will affect the shares from January 1, April 1, and June 30. That's why in January 1, we have 100,000 times 2. That's for the split on May 1. Then we multiply it by 1.20 because the bonus, and by 3 because of the split on December 31. Then on April 1 again, we have 30,000 times 2 because of the split, times 120 because of the bonus, and times 9 over 12 from April 1 to December 31. And sa January 1, that will be 12 over 12 or 1. So we may disregard the multiplying the figures by 1. However, in April 1, we have to count from April 1 to December 31, a period of 9 months. Then on June 30, purchase 10,000 shares for the treasury. So we have 10,000 shares. We multiply by 1.20 and by 3. That's the split. 6 over 12 is from June 30 to December 31. Now, the split 2 for 1 occurred on May 1. So, gani ngang June 30 is no longer affected. And since this is a treasury stock purchased, we have to deduct. So we have 720,000 plus 162,000 plus minus 18,000. The average shares is 864,000. Next, in number 19. Number 19, again, we have one requirement, and it's the weighted average number of shares outstanding for the year. The company provided the following share transactions for the current year. Now, in January 1, in number 19, we have shares outstanding of 44,000. February 1, issued for cash. Acquired treasury shares on May 1. August 1, 25% share dividend. September 1, resold treasury shares. And November 1, issued 3-for-1 share split. So that our January 1 is to be computed by multiplying 44,000 shares outstanding on January 1. Then we multiply by 1.25 because of the share dividend on August 1. And then we multiply by 3 because of the split on November 1. So we now get 165,000 shares. On February 1, the company issued 56,000 shares. So again, affected by the stock dividend. So you multiply by 1.25, and then you multiply by 3 because of the split, and multiply by 11 over 12 from February 1 up to December 31. By the way, that of January 1, we may multiply it by 12 over 12, but anyway, that's still equal to 1, will give the same result. However, in February 1, we really have to multiply it by 11 over 12, considering that the transaction occurred only on February 1. Then on May 1, acquired treasury shares by 25,000. So 25,000, this is now the treasury shares acquired. So meaning a deduction, and you multiply by 1.25 and by 3. 8 over 12 is from May 1 to December 31. And on September 1, we sold the treasury shares of 10,000. So September 1, hindi na affected sang share dividend because it occurred prior to the reselling of the treasury shares. So only 25,000 for the September 1 transactions. 10,000 we multiply by the stock split of 3, and we multiply by 4 over 12. That's from September 1 to December 31. So the average number of shares is 305,000. The weighted average number of shares. Then for number 20, what is the average number of shares that should be used in calculating the basic earnings per share? January 1, shares outstanding. April 1, 2-for-1 split. July 1, shares issued. Preference share capital 10. Par value 5% cumulative. January 1, shares outstanding 40,000. So we now have on in 19-20 on January 1, 200,000 shares, and then we multiply by 2 because of the split on April 1, and we multiply by 12 over 12, or this 12 over 12 may be eliminated. So you still get 400,000 shares. Then on July 1, shares issued 100,000 up to December 31. So it's no longer affected by the split because the transaction occurred after the split. So we have now 450,000 shares for 1019-20. Then 19-21, we have two questions. 19-21, one, what's the weighted average number of shares for 2020 for comparative financial statements at the end of 2021? So the following transactions occurred in 2020 and 2021. The beginning number of shares was in 2020 was 250,000 shares. We multiply it by 1.2 because of the share dividend that happened on July 1, and we multiply it by 3 because of the split up that occurred on June 1. So we now have 250,000 times 1.2 times 3. So 900,000 shares. On March 1, again the company sold 24,000 shares, still affected by the stock dividend and by the split up because the transaction occurred on March 1 and the share dividend was in July 1 and the split was in June 1. So on March 1, we have 24,000 shares times 1.2 times 3 times 10 over 12. That's counting from March 1 up to December 31. Then on October 1, sold 16,000 shares. So 16,000 shares times 3, why siya maapektahan sa share dividend? Because the share dividend was on July 1. While this one sold 16,000 shares occurred in October, but it is still affected by the split up. So we multiply it by 3, and 3 over 12 is from October 1 to December 31. Then on June 1, 2021, there was, no, on December 1, 2020, purchased 15,000 treasury shares. So December 1, 15,000, and we multiply it by 3 because it occurred prior to the split. So times 1 over 12, December 1 up to December 31. Now we have a negative 3,750. The average shares outstanding in 2020 is 980,250. Then for question number 2, the weighted average number of shares for 2021. So we have now January 1 for 329,800 shares. So 329,800 shares, then we multiply by 3, that gives 989,400. Then on September 1, we have the issuance again of 60,000 shares times 4 over 12 from September 1 to December 31. So the average number of shares is 1,009,400. That was for 2021. So on January 1, 2020, we have 250,000 shares times 1.2. So we get 300,000. On March 1, 2020, 24,000 shares times 1.20, and on October 1, 2020, 16,000, and December 1, 2020 for 15,000 shares actually outstanding in January 1, 2021 is 329,800 without giving regards to split, no, because the split occurred here in June 1, 2021. But prior to June 1, 2021, if you consider the number of shares, actually, ara na ang 1.2 nga share dividend. However, wala pa ang 3-for-1 split. So the actual number of shares for 2021 nga beginning of the year is 329,800, which we multiply by 3 because of the split up that occurred on June 1, 2021. So meaning the split up occurred only in 2021. So we now get the shares actually outstanding on January 1, 2021 of 329,800. Now we go to problem 22. Again, what is the number of weighted average shares? So on January 1, we have the shares outstanding, and we have now to multiply it by 2 or 100% to be added because of the 100% share dividend on December 1. So 2.5 million. On April 1, shares issued 200,000. Again, we multiply it by 2 because of the share dividend, and 9/12 from April up to December 31. Then the treasury shares purchase of 100,000, again affected by the as here by the share dividend. So it's now on April 1, no, on October 1, 100,000 times 2, you multiply by 3/12 from October 1 to December 31. So for 100,000 times 2, but times 3/12. So we have 50,000 to be deducted. The average number of shares on in during the year is 2,750,000. Next, we go to 19-23. In 19-23, we have the company, the following transactions during the year. The weighted average number of shares. On January 1, we have 300,000 shares, but on February 1, issued a 10% share dividend. So that will be times 1/10 times 12/12. Your 12/12 may be eliminated because it's still equal to 1. So 330,000 on March 1 issued ordinary shares in a business combination for 90,000 shares. We multiply by 10/12. We do not multiply this anymore by 1/10 because the issuance occurred only after February 1. So, but we multiply it by 10 over 12 from March 1 to December 31. And on July 1, the company issued ordinary shares for 80,000 times 6 over 12. The average number of shares is 445,000. The share dividend is treated as a change from the date the original shares are issued. Thus, the balance of 300,000 on January 1 would become 330,000 shares. Then we go to number 24. Theoretical value of right is equal to 35. It's given. And then we have to deduct 10 for one ordinary share. That's 25 divided by 4 plus 1. So you need 4 shares to buy one new share, and we add 1. So we have 25 divided by 5, or 5. The market value of share rights on is 35. Theoretical value of right is 5. So we have the total of 30. Adjustment factor is 35 divided by 30. So for the ordinary shares on January 1, 600,000, the ordinary shares issued through exercise of rights on October 1. That's equal to 600,000 divided by 4. So given. So you get 150,000 shares. The total is 750,000 ordinary shares by October 1. Now, in January 1, we have 600,000 ordinary shares. Then we multiply by 35 over 30 times 9 over 12. And on October 1, we have 750,000 times 3 over 12. So the basic earnings per share is 8,550,000 divided by 712,500, your adjusted number of shares. So we have now the amount of 12. Now we have 19 thus 25. The theoretical value of a right is 160. That's number 25. 160 minus the theoretical value of 10. So the market value of share X right is 150. Adjustment factor is 160 over 150. So the ordinary shares on January 1 given for 300,000. Then the ordinary shares issued through the exercise of the rights, 300,000 divided by 5. So we get total of 360,000. Then on January 1, 300,000 times 160 over 150 times 3 over 12. So we have now 80,000. And on March 31, 360,000 times 9 over 12, or 270,000. So we add 80,000 to 270,000. The average number of shares is 350,000. The basic EPS of 17.14. Then problem 19 does 26, again for requirements 1 and 2. What should be reported as basic earnings for the 2021 comparative income statement? So the ordinary shares on December 31, 2020 is 200,000. Then the bonus issue, that's A bonus was made on October 1, 2021, and the ratio of two additional ordinary shares for each original ordinary share on December 31, 2020. So meaning for every one you will receive two. So the bonus issue involves 400,000 shares. So the total shares outstanding is equal to 600,000. The basic earnings per share in 2020, the income of 18 million divided by 600,000 shares, so we get 30. In 2021, 60 million divided by 600,000 shares, we get 100. In 19-27, what should be reported as basic earnings per share? That's answer D. 19-28, you have the answer as B, the amount that should be reported as basic loss for the year. The basic loss of 3 million. Then we have 19-29 and 30 for the theory questions. Okay, so that ends our discussions of chapter 19. Uh, we will continue with chapter 20.